Hello and welcome to the Global View on this Thursday. I'm Andrew Gagan. Good to have you with us here at AusBiz. So, it was all about inflation overnight. Core US inflation rising less than expected in December, which saw the US dollar and Treasury yields fall as further rate cuts from the Fed were back in focus. Investors also buoyed by a ceasefire deal between Israel and Hamas, and adding to the bullish sentiment on Wall Street were earnings from the large banks. JP Morgan rose after it reported a record annual profit in the fourth quarter. Wells Fargo shares surged after its fourth quarter profit beat expectations as its deal-making activity boosted its investment banking business. Goldman Sachs shares jumped following its best quarterly profit in more than 3 years, while Citigroup swung to a profit in the fourth quarter. Morgan Stanley and Bank of America also gaining ahead of promising earnings results from them. And shares of BlackRock rose, with investment advisory and administration fees having surged in the fourth quarter. Well, US consumer prices increased by 0.4% in December, the most in 9 months, driven by elevated costs for energy, taking the annual rate to 2.9%. However, underlying price pressures have subsided after barely budging for 4 straight months, with core CPI increasing 0.2% in December, for an annual print of 3.2%. And the Fed's Beige Book showed economic activity increased moderately in December, with employment rising slightly along with prices. In response to the data, Fed member Austin Goolsbee said the trend continues to be improvement in inflation. I'm still optimistic for 2025 that we can continue growing and have a soft landing. And the inflation data prompted a slump in US Treasury yields. The 10-year down around 12 basis points to 4.66. That was its largest daily fall since November. And the 2-year down to 4.28%. And the US dollar weakened against most major peers, with the Aussie at 62.3 US cents. And cooling British inflation offered relief to the pound. UK consumer prices in December rose 0.3% and 2.5% for the year. And Bank of England policymaker Alan Taylor saying with the economy weakening, it's time to get interest rates back toward normal to sustain a soft landing. We could then need a more accelerated pace of rate cuts, perhaps 125 or 150 basis points in the coming year. And renewed risk-on appetite has seen Bitcoin close in on the $100,000 level. Oil prices have jumped higher, supported by a large drawdown in US crude stockpiles and potential supply disruptions caused by new US sanctions on Russia. However, the Gaza ceasefire deal limited some of those gains. Brent crude futures rose 2.6% to $82 a barrel. That's the highest since August. Copper rose more than 1%, similarly with iron ore up to $101 a tonne. And the gold price extended gains. US gold futures up 1.3%. to $2,717 an ounce. So let's get across that data and how it's moving US markets. Ira Epstein joining us from Linn Associates. Ira, very good to catch up with you. It's been a couple of weeks since I've had a chat with you. So, of course, that focus on inflation, a relief rally we saw there on US markets. Still signs that inflation is sticky, but looks as though markets are prepared to look through that with the possibility of further rate cuts.
Yeah, they are, but I think people are missing something here. We had PPI come in on the weak side. We've had the core CPI come in, but there's a big unknown, and that unknown takes office on Monday. And then he's signing 100 orders. What are those going to be, or what are they not going to be? And people have to understand that. That's very important. We also have another situation where you're going to have to start parsing data in the United States in a different manner. The fires in Southern California, the havoc that they've played, and remember, California by itself would be the 7th largest economy in the world. We are wiping out areas. These winds are still going tonight bad. We'll see how much damage, if there is more, if this thing finally burns itself out. But for years to come, I don't mean a year or two, years, minimum 4 or 5 years, could be a decade. They've got to rebuild an area. They're not going to get insurers that want to move back. The insurers can't cancel right now by law. But how do you go about saying what the unemployment number is. Do you do the unemployment ex-California for those workers at this point? And then it's going to get flooded with workers as they have to come in and rebuild the area. None of this happens overnight. So those are things to remember. I, for one, looked at the market as evening up going into the Trump era. And that will start on Monday. And how fast does he put tariffs on? What size tariffs are they? Well, you were going, Andrew, at first it was 25% tariffs. Now there's talk, is it going to be in 2 and 5% increments on Canada, on Mexico? I think China is an enemy of America from the Trump point of view, and he'll go after them with as much as he can, which will probably be at 10% on top of what's already there. Then when you started talking the energy markets, let's understand that the latest tariffs that the Biden administration suddenly sprung on Russia, if you look at what the market has done since that announcement, it's gone up because we've taken supply off the market. So their supply is gone. It will be made up by other OPEC members. Don't get that wrong. But the first thing that happens is, how do you get that around? Where does it come from? Europe's not getting that. Then you get the cold weather that is struck in the United States and the weather that's striking Europe. So you're getting demand across the board because it's mid-January. It's typically very cold. This is no exception. And we've had a number of Biden sudden moves, and now we're going to get the Trump sudden moves. So I do think today marked a moment where we could say, okay, maybe we have a trade bottom. That does not mean the trend is okay and it's going just back up, in my opinion, in the stock market. Energies have surprised the heck out of the market. IEA, they came out again bearish today. Why is the market rallying? It's because of what I just said, I think. And that means the market's going to look at Iranian oil when Trump comes in, and he's not going to be kind to Iran. You can count on that.
Yeah, okay. Lots of uncertainty as we lead into the inauguration of Donald Trump. Ira, how are you looking at the US economy at the moment? We did have the Beige Book. Also, the latest manufacturing read from the New York Fed, which was weak.
Absolutely weak. If you looked at the Empire State Manufacturing, exceptionally weak. I read the whole Beige Book, and it takes a long time to read it, but I read it today. And what I see is moderation. Prices aren't going up. Wages, this seems to be universal at this point, they're not seeing wage pressures. That's with the market, but they're also seeing that demand isn't picking up really strong. If anything, there are some concerns out there. We know the service sector has been the area that's been drawing everything in America. It's been the one constant, but you can come to Chicago and you see the manufacturing is down. You see that as to what's going on in New York. We're going to get all the retail sales numbers shortly. Did we have a really good Christmas season? That's going to be a question that we ask ourselves. So do I think that we're ready to just move? I think we're at an inflection point where over the next week or so, when I come back with you, Andrew, we're going to know a lot more answers to what's going on via what Trump does or doesn't do. I think that all that today was finally we got inflation numbers that show some weakening, and that's very important and should be applauded. But what did it take to get there? Nearly 5% interest rates on the 10-year note. Mortgages in the United States at 7.25%, 7.2%. Housing market that is strong. Why? People are adjusting to 7% mortgages, and they're starting to buy new homes. They're ordering them up, and the books are filling.
Now, of course, Ira, we are launched into the latest earnings season with the banks reporting. Some really strong numbers there. How did you interpret it?
Powerful. Trading, mergers, any way you want to look at it, they're on fire. And again, think of why they're on fire. What's the interest rate number right now? You've got that. Why else are they on fire? Because you're getting rid of a Biden era where they have been against mergers, acquisitions, an SEC that was against everything under Gensler, and now we're getting a whole different realm in there. So the market's looking at that as good, but that's not the earnings. That's what's coming. The earnings just picked up in spite of higher interest rates and all, and that is the good thing. And that's because the U.S. economy has an inflation that is not as strong as other places. It's strong, but not on fire, but it's strong. Other places are weak, and our job market is just super strong. I mean, 4.1% unemployment is for all purposes. If you want a job in America, you have it.
And Ira, commodities. So let's first take a look at gold. Are you still liking gold at this point?
Absolutely. And last time I was on with you, I surprised you when I said I like Bitcoin. And it's about $8,000 higher than my last appearance when we were there. And I did stick my neck out on gold and said, I think gold's a $3,000 commodity this year. So I see all the reasons to go there. And the reason I'm saying that to you is I think central banks will do a lot of buying as the dollar stays strong and their currencies fall. I think that we will just look at a situation where inflation in the United States subdued from here maybe, but not cracking down in any manner. I am not looking for the Fed to hit, and I've said this on this show over and over, that 2% number that the Fed looks for. It would be strange to get to it. I think they'd be better off abandoning that, like I've said, and talk a range, maybe 2 to 3%, something in that thing. I think it would give them more credibility.
And Ira, oil, how do you look at that market at the moment? Obviously, with some geopolitical issues playing out there, further sanctions on Russia, and of course that ceasefire deal between Hamas and Israel.
I would like to answer that next week, and here's why. What is Trump going to do? We know what Biden did. And if you think about it, if this wasn't political, I quit my analysis. All this could have been done during Biden's term. The reason it wasn't done is he wanted to keep oil prices on the low side. The moment he sanctioned 183 tankers, the moment he went after Gazprom and another company, as you do that, you spook the market. And now we have an administration we know is going to come in and go after Iran. So he was rough on Russia. What happens if Russia in the next 5-6 months makes a deal with Ukraine and that stops? The sanctions start coming off and the IEA numbers become very realistic, and I think you go down. So I think we're up because of a supply situation, not a demand situation. I'd be very wrong in that analysis. If the demand out of China started picking up, I see China in a spiral down, not even stabilizing yet. So I'm very concerned about China.
Ira, terrific analysis as always. Thanks for joining us on Linn Associates.
Thanks for having me, and good New Year.
Check out the local market as we get going, looking for a rally reflecting what we've seen on global markets. SPY futures up 1.25%. Stay with us because the open is a couple of minutes away.